We've seen a little bit more optimism on trade deal that's going on in the last few weeks in particular. And in particular, we're coming close to a stage 1 deal. Now that's not rectified quite yet, but definitely has given more optimism to the markets and feeling that at least the worst case scenario on global trade is now behind us. We're also being a little bit more optimistic about where interest rates might be going, and that probably is the fact that they're not going anywhere in the near future. So that's less volatility in the markets, and that I think has also helped support markets to be a little bit more stable in the last few weeks in particular. So Bank of Canada didn't cut rates this past week, which is good news. I think the reason why we think it's good news is because if you think about real estate and you think about consumer debt, if you were to cut rates, consumers will probably tack on more debt and the real estate market would continue to go significantly higher. These are already two big risks in Canada's economy, and you don't want them to get even more elevated. And I do think that by staying still as well, it gives the Bank of Canada some time to think about the economic data and maybe things turn for a little bit better and they don't need to cut rates. If they jump too early right now, they just heighten some of those risks and they don't have enough information to really make that call. So in my mind, definitely a good move by not changing interest rates. Biggest news still is going to be what happens on December 15th. The tariffs are going to be an important thing. If tariffs are rolled back or those tariffs on December 15th do not get implemented, that's great news for the markets. The markets will really anticipate that as a good sign that the conversation between China and the US are going really well, and we can see markets potentially hit new highs. That being said, we still don't have phase 1 solved and written out in a way that people would say, great, now we can move forward to maybe phase 2 and phase 3. So there's still a lot of uncertainty from now till then, and we really want to see what news we get out of both China and the US that may give some indication where these things are moving forward. So that definitely is by far the biggest thing we're watching for. Maybe a less important, at least for now, is what are the future direction of interest rates, both by Bank of Canada and by the Fed, and really around the world as well. Is rates going to remain at the low levels that we anticipate, and that could at least fuel the economies to go a little higher up and markets to move in the same direction? Or do we get some signs that maybe there's somebody indicating to raise rates, and that would be a sign that maybe the markets won't anticipate as well, and probably we'll see maybe a decline and maybe some sell-off there. So that's an important thing to keep an eye out as well. I don't think we're going to get much information from now to the end of the year on that. So really the most important information really is global trade and what happens on December 15th with respect to tariffs. We still have today a slightly defensive tilt in our portfolios, maybe a little less so than we would have had the last time we chatted. And the reason has been that though we see a lot of risks still out there, maybe some of those risks are come off a little bit. So global trade seems to be heading in a better direction. Brexit seems to be heading in a little bit more of a better direction as well. So those signs are telling us that maybe the market might be a little bit more upside still left here. And so though we are underweight equities, we are less so than we were previously. And if we look out going forward, we still do want to have some defensive positioning in our portfolios, whether that's higher quality bonds or again focusing in areas on the equity side that have higher upside and maybe less downside to the portfolios as well. So Canada is a good example where we see if markets do sell off, there's better downside protection there. And if markets go higher up, we do want to have some offensive, in the US market where we see earnings a little bit better than anywhere else. So again, markets are really going to be more range bound in this environment. But again, a lot will depend on what we see on global trade. And we're positioning ourselves to have some downside protection, but still some kickers in the portfolio should the markets go and hit new highs going forward.